Chapter 1. Introduction to Corporate Finance. Question 7. Answer the following. 8 marks each. 1. Discuss the importance of corporate finance. Answer. According to Henry Hoagland, corporate finance deals primarily with the acquisition and use of capital by business corporation. Corporate finance is the division of finance that is related to how corporations deal with funding resources, capital structuring, and investment decisions. It deals with acquisition and use of finance by a corporation. Following points explain the importance of corporate finance. 1. Helps in decision making. Finance is the lifeblood of business. Important investment decisions of business are based on the availability of finance. There may be various alternatives for investment, but the management selects the one which will enhance profitability of the organization. Thus, corporate finance plays an important role in decision-making process of the management. 2. Helps in raising capital for a project. Whenever a business organization wants to start a new project or venture, it needs project finance. Project finance can be raised by issuing shares, debentures, bonds, or taking loans from the banks, and the same are paid back from the cash flows generated by the project. 3. Promotes expansion and diversification. Expansion means to increase the size of the company, and diversification means to produce and sell new products. Modern machines and modern techniques are needed for expansion and diversification, and finance is needed for purchasing the same. Corporate finance fulfills this requirement. 4. Brings coordination between various activities. There are various activities in a business organization, and corporate finance is significant in coordinating all these activities. For example, if finance department does not provide adequate finance, production will suffer, sales will be adversely affected, thereby affecting the profits of the organization. Thus, efficiency of every department primarily depends upon the effective financial management. 5. Managing risk. The company has to meet many contingencies, like sudden fall in sales, loss due to natural calamity, loss due to court case, loss due to strikes, etc. The company needs finance to meet these contingencies and manage the risk. 6. Helps in research and development. Today, a company cannot survive without continuous research and development. It must also invent new products. For this, research and development must be undertaken. It is a lengthy process, and therefore, funds have to be made available throughout the research work. Thus, corporate finance is needed for research and development. 7. Payment of dividend and interest. The company has to pay dividends to the shareholders. It has also to pay interest to the debenture holders, banks, etc. It has also to repay the loans. Finance is needed to pay dividend and interest. 8. Replace old assets. Plant and machinery are the main assets of the company. However, after some years, these assets become old and outdated. They have to be replaced by new assets. Thus, finance is needed to buy new assets. 9. Payment of taxes or fees. There are many government agencies, such as income tax authorities, registrar of companies, etc., to whom the company has to pay taxes or fees. Finance is needed for paying these taxes and duties. 2. Discuss the factors determining working capital requirement. Answer. Working capital is that part of the total capital which is required for running the day-to-day operations of the business. Working capital is in the nature of stock of raw materials, semi-finished goods, finished goods, trade debtors, cash and bank balances. The factors determining working capital requirement are as under. 1. Nature of business. Companies engaged in production of essential goods require less working capital, as there would be regular cash inflows in business. Trading or merchandising firms have to carry big inventories of goods and have to extend credit facilities to attract customers. Hence, they need large amount of working capital. 2. External factors. If there is easy availability of finance from banks and financial institutions, the need for working capital is reduced. On the contrary, if funds are not available, as and when required, it will necessitate more working capital for the business. 3. Terms of purchases and sales. If a company makes purchases on credit and sells on a cash basis, then it will require less amount of working capital. Conversely, if it purchases on cash and sells on credit basis, then it will need more amount of working capital. 4. Production cycle. Production cycle means the period involved in converting raw materials into finished product. If the production cycle is long, more working capital will be needed, as capital remains blocked in raw material and semi-finished goods, and if production cycle is short, less working capital will be needed. 5. Volume of sales. There is direct relationship between the volume of sales and the size of working capital. If the volume of sales increases, there is an increase in the requirement of working capital, and vice versa. 6. Credit control. If the credit policy is strong, the recovery from customers will be fast, thereby improving its cash flow. Such a company will require less working capital. On the contrary, if the credit policy is liberal, more credit period is given to customers. Hence, more working capital is needed. 7. Business cycle. Business cycle consists of a boom and recession period. During the boom period, the sales are very high. The company has to spend a lot of money on raw materials, wages, etc. So, it requires more working capital. During recession, the sales decline, as people tend to buy less. Hence, the need of working capital will also decline. 8. Management ability. If there is effective management and proper coordination between production and distribution of goods, the requirement of working capital would be reduced. However, if the management is poor, the firm will be stocking heavy inventory, which will necessitate higher working capital. 9. Size of business. There is a direct link between the working capital and the scale of operations. Hence, more working capital is required in case of big organizations, while less working capital is needed in case of small organizations. 10. Growth and expansion. Growth means increase in the scale of business operations. The organization, which has sufficient possibilities of growth, require more amount of working capital, as a growing company needs regular funds to support large-scale operations.